What's going on? I want to talk about something and I want to make something clear. And I think this will give a lot of people some understanding. And my fragrance today is Desire Toxic. We're going to go over why you're not receiving compensation for your investment securities, i.e., loans. And this is really going to help some of you guys put things in perspective because there's some people who are not able to put this together because they're not able to see what's going on. But this will help some of you guys put this in perspective. And it should be very simple for everybody to understand once I go over this. Okay, you have to understand that you're not actually getting a loan, you're giving a loan. Okay, so when you read your agreements, you're actually pledging a loan. Okay, this is a actual dead pledge. All right. So when I'm giving out a loan to a corporation and I am not receiving compensation, I am entitled to be compensated. Why? Because I am the issuer of the instrument. Okay. So now you have to understand what a dead pledge is. Okay. In law, the conveyance of an estate to another for money borrowed to be held by him until the debt is paid out of the rents and profits. All right. So I said a lot while saying a little. So you're thinking when you receive a note that the obligation is to be paid out by you, but the obligation is actually to be paid out by the person who is holding the note. Does that make sense? Because if you're signing the note, you're issuing the note, you have what is a beneficial interest. Okay. And the reason why a lot of people did not understand this beneficial interest is because we're not taught this. You know, a lot of this stuff we're not taught in school. Nobody's teaching us this. So, but not nobody, but there are people on the internet that are now, waking up and teaching this. But you have to understand what a beneficial interest is. So, a beneficial interest refers to a right to income or use of assets in a trust. People with a beneficial interest do not own title to the property, but have some rights to benefit from the property. This is to be contrasted with trustees or other agents of the trust who only have managing duties. Now, when you set up an account, when you get approved and they come back and say, "Hey, sir, you're approved for this credit card. Hey, sir, or ma'am, you're approved for this house. Hey, sir or ma'am, you're approved for this car." The bank is taking up management duties. They're not. They're your trustees. So they're the ones that are managing the account. They are not a beneficial interest holder. That's why they could sell and transfer the account. Because if you don't know how to claim your interest into an account, then it could be transferred to someone else so they can claim their interest. So now we went over that. We must understand what a beneficial interest holder holds. So if the beneficial interest holds an asset is something of value owed by an individual or an organization. So if I sign a promissory note, the moment I sign that promissory note, the wording in the promissory note shows that I pledged the agreement for a future date, meaning that's the maturity date of the agreement. All right. So if I pledge an agreement out, when is it due? It's due at its maturity date. Okay, so we'll go over that and I'll come right back to assets so you understand. So sometimes people say, "Why are you jumping around?" This is the only way I can explain certain things because if I just go one by one, you might not get it. And it's very hard to explain this because it's really all over the place. It's not really in one place. All right. In a loan transaction, the date on which the term of the loan expires and the outstanding principal of the loan must be repaid to the lender. Okay. Remember, the bank has not lent you anything. So even if you go to a bank and sign a promissory note, right, and the bank gives you a check, the bank still has not lent you a dime. If you understand banking, the bank's books must balance by the end of the day. So every transaction they're doing with you, their books are balanced. It's your books that are imbalanced. Okay. So this is what loans are. There is when I say stuff like there is no money. When I'm saying that, I'm meaning that all obligations are really just accounting. That's all it is. When you write a check, it's just an accounting. Okay. All other amounts payable by the borrower under the loan agreement, such as interest, fees, and expenses, must also usually be paid at maturity. Now we have to understand who is the borrower. Okay, who is the borrower? Okay, and so the easiest way to do this, and I always try to tell people, um, you really want to learn kind of what's going on, and it makes it a lot easier for you because I know this is hard to see for a lot of people, and the reason why it's hard to see is because you've had the wool pulled over your eyes. A lot of people think when I'm talking how I talk, like I'm talking like I'm better than you. No, I was in the same situation as you. Obviously, I was. That's what brought me to this conclusion. So, if you don't like the way I talk, or if you don't like the way I'm speaking, you think it's condescending in nature, well, welcome to the real world. Okay. You don't have to watch any of my videos. I'm not putting a gun to your head. I'm not making you come over and watch any of my videos. If you don't like them, just leave. Okay. Old English, borrow. So we know it's a verb. So it's something you do. In Old English, bargaining, to lend, be surety for. Okay. Pledge. Okay. So look, pledge, security, bail, debt. So I'm not going to get into all of that. I'm just going to basically read what it means. Borrow, to take up money. So to take up money, right? To become bail for guarantee. To protect guarantee. So when you're signing a promissory note after the bank approved you for an alleged loan, the promissory note acts as a security to protect the guarantee, meaning the person who guaranteed to pay the loan back, which is the lender. Okay, so what you're getting is a deferred advancement, a deferred advancement. So we'll go over to what a deferred advancement is, and this will help you. Advancement payments are amounts paid before goods and services are actually received. The balance that is owed, if any, is paid once delivery is made. These type of payments are in contrast to deferred payments or payments in arrears. In these cases, goods or services are delivered first, then paid for later. All right. So the when you get into an actual pledge or a loan agreement, you've already, once you've endorsed the promissory note, you've already settled the obligation, but you haven't settled the accounting of the obligation, if that makes sense. All right, so let's go back. All right. So now you know that your loan is actually in arrears to you because you haven't been advanced the money to actually be loaned. So the bank still owes you the money. Don't get it twisted. The bank still owes you money. Okay, so now we understand what a debtor is. All right. The debtor, the term debtor comes from the word debt, which originated from the French word dit, which came from the Latin word debri, uh, debere, meaning to owe. Now, what is the difference between a debt and a debtor? Debtors are those individuals or entities who purchase any goods or services on credit and for which they owe money in return, which is the difference between debtors and debts. The answer: the debtor is any person or company that owes you money. Okay. Now, if I gave you a promissory note and the promissory note was it was in lieu of a potential loan, well then why would I not raise that issue to say, hey, you never advanced the funds. You never advanced the money to me. So you have me on the hook as the debtor, but you never actually delivered the goods and services because the bank hasn't. If you purchase a car, the bank does not own the car. If you purchase a house, the bank does not own the house. If you have a credit card agreement, the bank does not own the asset device, which is the credit card, or they do not. They also do not own the credit application. So when you understand these things, you will understand what I'm saying more. So I understand sometimes it may seem like I'm speaking over people's heads or in a way that people don't understand, may not understand. But I'm really trying to explain something to people, you know, and why you should never be lazy or you should never sit there and look for people to always do research for you. You always want to research on your own. So we have to understand if a dead pledge is considered an asset. So if a dead pledge is considered an asset, right? So an asset is something of value owned by an individual or an organization. An asset can be physical property like a building or intangible property such as a patent. Okay, if the asset is not owned by the bank, then it is not their asset. Okay, if the credit card application is not owned by the bank, it is not their asset. They are just a holder. Okay, a holder is a trustee because they are an asset manager. Do you understand? So that's why I tried to show you that a holder is no one more than a person who manages an asset. Okay, assets are an important part and differ from many areas of law. Okay, so I don't need to go into all this because that's not really going to tell me anything. So now we have to understand if a debt pledge is held by an asset manager until the debt is paid out and out of the rents and profits. Well, wouldn't you compel the rents and profits to be paid to you, which is the issuer? Sounds like something that somebody wants to look into. Okay. So whenever you sign a lease agreement, the landlord becomes a holder of that lease agreement. And most landlords do not understand that they're dealing in securities. So the landlord looks at the person like, hey, you know, you need to pay me rent. and they're not taking the securities and getting the rent paid on their own. So that's why landlords don't even understand that they don't even have the power to evict their own tenant because they don't understand the game in the grand scheme. All right, so we understood what the now we understand what these terms mean. Okay, we can understand what a beneficial interest is. All right, so we already went over that. This is a contrast with the trustees. Okay, so what is a trustee? A trustee is a third party who is authorized by a settler. Okay, if you ever heard this, I will tell you that you are a settler. Okay, what is a settler? A settler is a party that creates a trust, usually the donor. Okay, that's you. Okay, I'm hoping that this breaks down this for you. When you when you sign an agreement, you transfer your interest. You're the donor. You control everything. Just read the power of appointment. I'm giving you breadcrumbs to come home and wake up. Once you wake up, you're going to be the most powerful person in your life. Look, all right. So the settler is the party that creates a trust. When you apply for a loan and then you agree to transfer your information, you become the settler or the donor. Okay. The settler transfers legal title in some asset to the trustee. What? Who's been saying this? I have. The settler then provides in the trust instrument how the trust property is to be used for the beneficiaries. So you're saying how, when you sign an agreement, the reason why the bank usurps you is because you never read the agreement that you signed. See, you never read it. So when you never read it, what you've done is you've signed an agreement and you've elected anybody to be a beneficiary that holds the instrument. This is why I tell you stuff about bearer paper. When you're signing it, bearer paper can be held and enforced by almost anybody. So now you've agreed to be a slave, unknowing by you. Okay. In the case of an inter vires trust, the settler can also be the beneficiary. Additionally, the settler can be the trustee in case of self-declared trust. So when you're reading these, an inter vires trust is a trust that is created during the lifetime of a settler. Okay. See, this is why learning and doing research is so important because the more you learn and the more you do research, the stronger your knowledge will get. When you start bringing claims, they'll start making more sense. If you start bringing claims where you don't know, that's why I try to tell people learn this information and take your time. The reason why I tell you that is because you don't want to start writing claims that don't make sense. And then when you send them to the bank looks at you like, what are you talking about? You have it right here in black and white. I'm showing you how to make a claim. An intervarious trust can be distinguished by a testamentary trust, which is created in a will that begins upon the death of the testator. So look at these terms. Testamentary trust is a trust that is created in a will. It begins upon the death of the testator. So, all right, an inter vivos trust can be helpful in avoiding costs and complexities of the administering the trust, a settler's assets after death, because an inter vivos trust is a legitimate means for the settler's estate to avoid probate administration. Okay, so like when the bank is billing you, right? The bank holds the legal title, and then they send you a statement every month. The reason why they're sending you a statement every month is because you don't have the agreement set up correctly. All right. That's why they're sending you a statement every month. Does that make sense? I hope it makes sense to people. So we'll go into what an estate is, because I think there's a information about estate. State is rank, standing, condition. Okay, I'm going past all of these like bracketed Anglo French. It's that you can read that. You can read it because it's on the screen. Okay, so state, position, condition, health, status, legal estate. Okay, state or condition, position, place, social position of an aristocracy. Okay, to stand, make, or be firm. All right, so the sense of property. Okay, from that of worldly prosperity, specific application to landed property, is first recorded in American English, 1620s. A native word for this was Middle English, Ethel. Okay, ancestral land or estate, patrimony, meaning collective assets of a dead person or debtor. Okay, so people always tell you the decedent's estate. No, it doesn't always have to be the decedent's estate. It can be the debtor's estate. And this is from the 1800s. Okay, so the words have changed over time. So an estate can be anything that is the presumption of a so-called creditor-debtor relationship. So since you are engaging in these securities transfers, you have to understand what are the elements of a loan, and we'll get into that. So, a loan is a a financial arrangement where a lender provides funds to a borrower. Okay, so you have to remember they're the borrower, but they take their books and make you the borrower on their books. So then they're seen as the creditor, but they've never credited you. Why do they not credit you? Because it's a deferred payment. So, all right, so the lender provides funds to the borrower. So once you sign the promissory note, a promissory note can act as a check or as cash if it is endorsed or if it is used in that fashion. And a borrower agrees to repay the borrowed amount along with interest over a specified period. The key elements of the loan typically include principal, interest, term, repayment schedule. Okay, so collateral, interest rate type, fees, covenants, default, repossession times. All right, so we'll get to what I was talking about. So I asked, is it possible for a business to receive a promissory note as a deferred asset, and to to not pay it to the actual interest holder or the issuer? And it said yes, it's possible for a business to use a promissory note or other financial instruments to gain capital or receivables without directly providing a traditional loan. In some financial arrangements, businesses may use alternative methods to access capital or leverage their receivables. Two common methods are promissory note as collateral. A business might issue a promissory note as a promise to repay a specified amount at a future date. This promissory note can then be used as collateral to secure a loan or other financial transaction. In this case, the business is not receiving a loan directly against the promissory note, but is using it as a valuable asset to secure funding. So, really, that's what you're doing. You're using the note to actually give the bank a security interest to provide funding. Okay. So when you do that, you become the donor. Okay. When you're the donor, you control the whole thing. This is why I did the video talking about the FDCPA and saying that the FDCPA really is to govern the secondary market, not the primary market. Okay, you think it's for the primary market, but that's why most people are confused. That's why I'm trying to tell you. A lot of people are confused about some of this stuff, and I'm just trying to break it down easily. But going forward, I probably won't be doing this as much because I mean, if people don't appreciate it, don't like my tone, why should I? Why should I bother? My channel's not big enough to, really keep going. So, look, receivables, financing, or factoring. Instead of obtaining a traditional loan, a business can sell its receivables, invoices, to a financial institution or a third party factor at a discount. The, the business receives immediate cash for their receivables, and the factor assumes the responsibility of collecting payments from customers. This method allows the business to convert its account receivables into immediate capital without incurring a debt. So if they can do it, why can't you? And with that being said, I'm out. Deuces.